Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking PCP versus HP versus personal loan, the honest UK car finance guide today, and tying it back to the wider cost saver ecosystem, including tools like UK Car Finance Engine, PCP versus HP versus personal loan, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Welcome back, everyone. Today, we are diving into something that, honestly, I think confuses just about everyone at some point: car finance. And with me to untangle it all is Assad. Hi.
Hey, Angela. Thanks for having me. Yeah, car finances, it's a minefield, isn't it? I mean, the jargon alone can make you want to just, buy a push bike instead.
Right? It's like they're deliberately trying to make it sound complicated. PCP, HP, personal loan, it's just a lot. And I think a lot of people, myself included, honestly, probably just go with whatever the dealership suggests and hope for the best.
And that's where the problem starts, really, because the data shows that average UK drivers overpay by anything from £1,200 to £3,400 over a 4-year agreement, just because they picked the wrong product for their situation.
Wait, up to 3,400 pounds? That's a holiday.
It is a holiday. It's a very nice holiday, actually. And it's not because people are being stupid or anything. It's just the way these products are sold, the emphasis is always on monthly payments, never on total cost. And those are two very different things, which we'll get into.
Okay, so let's start from the beginning. What are the three main options?
Right, so you've got personal contract purchase, PCP, which is probably the most common for new cars now. Then hire purchase, HP, which is kind of the traditional route, and then just a plain unsecured personal loan from a bank or building society. That's it, 3 products. They all let you drive off in the car today, but the ownership structure and the end-of-term choices are wildly different.
Okay, PCP first, because that's the one I hear about most, but I'm never quite sure what it actually, what am I paying for?
So with PCP, you pay a deposit, and then your monthly payments only cover the car's expected depreciation over the contract, usually 2 to 4 years. So you're not paying off the whole car, you're just paying for the chunk of value it loses while you're driving it.
Oh, so that's why the monthly payments are lower.
Exactly. And then at the end, you've got 3 choices. You can hand the car back and walk away, you can pay a big lump sum, they call it the balloon payment, to keep it, or you can use whatever equity you've built up as a deposit on your next car. And that third option is how dealerships keep you in the cycle, basically.
I hadn't thought about it like that. So it's sort of designed to keep you coming back.
Kind of, yeah. I mean, it's not inherently bad. It genuinely does make more expensive cars reachable on a modest monthly budget, but you need to go in with your eyes open. Oh, and one thing, ask the dealer for the Guaranteed Minimum Future Value, the GMFV, in writing, because if they've been optimistic about the car's future value, your monthly looks great, but you'll have almost no equity to roll into your next deal.
Right. Okay, noted. And HP, that's the simpler one?
Much simpler. You pay a deposit, fixed monthly payments across the term, typically 2 to 5 years, and once that final payment clears, the car is yours, outright. No balloon payment, no mileage limit, nothing. It's just yours.
But the monthly payments are higher.
Yeah, because you're chipping away at the full value of the car, not just the depreciation. But at the end, you actually own something. You can sell it, keep driving it for years with no further finance costs. There's something to be said for that.
Yeah, there really is. And the personal loan?
So the personal loan is, well, it's completely separate from the car itself. You borrow the money from a bank, you pay cash for the car, and the lender has no claim on the vehicle. The car is yours from day one. And that last point matters more than people realize.
Why's that?
Because the loan is unsecured. The rate depends heavily on your credit score. But if your score is strong, personal loan rates can genuinely undercut both PCP and HP APRs by a meaningful margin. You're basically a cash buyer at the dealership, which also gives you negotiating power on the price of the car itself.
Oh, that's a good point. Yeah. So now the big question. Which one is actually cheapest?
And this is where I have to be annoying and say, it depends what you mean by cheapest.
Of course it does.
No, but seriously, cheapest monthly payment and cheapest total cost of ownership almost never have the same answer. And confusing those two things is literally how thousands of UK drivers end up overpaying every year.
Okay, so let's do them separately. Cheapest monthly first.
PCP, hands down, and it's rarely even close. So, take a $25,000 car. PCP payments might be around £280 a month. HP would be around $430. Personal loan maybe $450 over the same term.
Wow, 280 versus 450? That's a massive gap.
Massive. And that's why PCP dominates the new car market. It genuinely makes expensive vehicles feel affordable. For families who need a bigger car or people looking at company car alternatives, that's a legitimate benefit. But, and I keep coming back to this, a low monthly payment is not the same as a cheap car. If you never buy the car at the end, you've paid thousands to essentially rent it. And then you need another finance agreement for your next car, too.
Right. So, what about total cost? If I actually want to own the car at the end, who wins?
This is where personal loans and HP fight it out, and the winner is almost entirely decided by the APR you can get. So, okay, let me use a real example. Can I do that?
Please do. Yeah. Numbers help.
So there's this example of Sarah from Leeds, a teacher, buying a $22,000 used family estate. 4-year term, $2,000 deposit. On PCP, her monthly payments are around £245, but there's an $8,500 balloon at the end. If she buys the car, total paid is $22,260. If she hands it back, she's paid $13,760 for the use of it.
Okay.
On HP at 9.9% APR, monthly payments are around $465. Total paid, $24,320. She owns the car outright. And the personal loan borrowed $20,000 at 7.5% APR, monthly payments around $483. Total paid, including her deposit, $25,184.
So, in that case, HP is actually cheaper than the personal loan.
In that specific case, yes, because the dealer APR is lower than her personal loan rate. But, and this is the crucial bit, if Sarah's credit score bumped her personal loan rate down to 5.9%, the loan becomes the cheapest total cost option by around $400.
So, it literally comes down to the rates you can get.
Exactly. Does that make sense? The best answer changes based on your credit score, the specific rates on offer, and whether you actually want to own the car at the end. There's no universal winner.
It does make sense, yeah. So, how do you actually figure out which is cheapest for you, specifically?
Okay, so step 1, get your credit score. Experian, Equifax, or a free service like ClearScore. Step 2, use a soft search eligibility checker to see what personal loan rates you'd realistically be offered. Step 3, ask the dealer for their best HP APR in writing, including any manufacturer contributions. And then, this is the important bit, compare the total amount payable, not the monthly, the total. That single number bakes in all the fees and lets you compare honestly.
And just to check, running a soft search won't hurt your credit score?
No, soft searches are invisible to other lenders. Zero effect on your score. Only formal applications leave a mark, so there's no reason not to check.
Good. That's actually reassuring. Now, you mentioned flexibility earlier. How does that stack up?
PCP wins again on flexibility, but for different reasons than the monthly cost thing. Those 3 end-of-term options give you an exit strategy. If your circumstances change, new baby, job change, you suddenly need an EV instead of petrol, you can hand the car back without being stuck with a depreciating asset. That flexibility has real financial value, even if it doesn't show up in a straight APR comparison.
But there's a catch, right? The mileage thing?
Oh, big catch. PCP contracts have mileage limits, and going over costs typically 6p to 30p per mile. So if you drive more than 12,000 miles a year, you need to be brutally realistic about your annual mileage. Otherwise, the cheap PCP becomes very expensive very quickly.
And what about damage, like normal wear and tear?
Yeah, so on PCP, damage beyond fair wear and tear gets charged when you hand the car back. And the BVRLA standards are stricter than most people expect. A scuffed alloy, a small dent, a stone chip that's broken through the paint, each of those can be $75 to $200. On a car returned after 4 years, those add up fast.
Ah, that's the kind of thing that would catch me out, I think. What about other hidden costs? Because I feel like there's always something lurking in the small print.
There really is. So, option to purchase fees. On both PCP and HP, there's usually a fee tacked on to the final payment, anywhere from $10 to nearly $300. Easy to miss when you're comparing quotes. And then there's all the add-ons dealers love to sell. Gap insurance, paint protection, extended warranties, service plans.
Are any of those actually worth it?
Some are, honestly, but most are overpriced compared to buying them separately. Gap insurance is often 3 to 4 times cheaper from a standalone provider like ALA Insurance. Paint protection is rarely worth the $300 to $600 they charge. Service plans can be okay, but rarely save more than they cost. And oh, this is important. You have to buy gap insurance separately. The FCA introduced a mandatory cooling off period, so dealers can't pressure you into buying it on the day.
Huh, fair enough. So basically, don't buy anything on the spot.
Pretty much. Get a quote from a specialist first, always.
Okay, let's talk about the bigger picture stuff. Because a car payment doesn't exist in a vacuum, does it?
No, and this is something people forget. Committing $300, $400 a month for 4 years is a serious decision. It needs to fit alongside your emergency savings, your investments, household bills. Before you sign anything, make sure you've got a proper safety net. Because losing your job with a $400 monthly car payment is a very different experience to losing your job with no car debt.
That's a sobering thought.
And there's a specific number to watch. Never let a car payment push your total debt-to-income ratio above 40%. Lenders use that figure when assessing mortgage applications. A big PCP or HP agreement can shave tens of thousands off what a mortgage lender will offer you.
Wait, really? Tens of thousands?
Yeah, people don't connect those dots. They take on a car finance deal and then wonder why their mortgage offer is lower than expected. It's all linked.
Okay, that's something everyone needs to hear. So, what's the single biggest mistake people make with car finance, if you had to pick one?
Walking into a dealership without a pre-approved personal loan offer in your back pocket. That's it. Even if you end up taking dealer finance, having that loan quote gives you a benchmark and negotiating power. Under FCA rules introduced in 2021, dealers can't earn commission based on the interest rate they set anymore, which is meant to make it fairer. But you should still always compare against an independent quote.
And I suppose the other big one is just focusing on the monthly payment and ignoring total cost.
Yes, that and rolling negative equity from an old PCP into a new one. That's a trap that just compounds over time. Oh, and underestimating mileage on PCP, not checking insurance groups when comparing cars, and not asking whether 0% finance offers are contingent on paying list price, because they usually are.
Oh, so 0% deals aren't really free money?
Not usually. Manufacturers typically inflate the list price or reduce the deposit contribution to compensate. So always ask what discount you'd get for a cash purchase before agreeing to the 0% deal. You might find the cash price is, significantly lower, and a cheap loan on that lower price works out better overall.
That's sneaky, but I suppose it makes sense from their perspective. Okay, one more thing. What if you're already in a deal and you can't keep up the payments? Because that must be terrifying.
It is, but there are protections. All three products have voluntary termination rights once you've paid at least 50% of the total amount payable. And under the Consumer Credit Act, you can settle any regulated agreement early, though there might be a small interest rebate calculation. Personal loans are usually the easiest to settle, but the main thing is speak to your lender early. They genuinely rather restructure than repossess. Don't bury your head in the sand.
That's reassuring to know. Okay, Assad, let's do a quick recap because I think people are going to want the cheat sheet version of this.
All right. So, you want a new car every 3 to 4 years and low monthly payments? PCP. You want to own the car long term and you've got decent credit? Personal loan. Probably your cheapest total cost. Credit is fair or poor, but you still want to own it? HP. You do more than 15,000 miles a year? HP or personal loan. Avoid PCP. Buying a used car under 10,000 pounds? Personal loan is usually cheapest. And if you're looking at a new EV with manufacturer subsidies, PCP often wins because of the contributions they throw in.
And the golden rule?
Be honest about your goal before you start shopping. Do you want low monthlies or do you want to own the car for the lowest total cost? Get quotes from at least 2 independent lenders as well as the dealer. Compare total amounts payable, not headline monthlies. It takes about 10 minutes and it can genuinely save you thousands over the life of the agreement.
That is brilliant. Assad, thank you so much. I feel like I actually understand car finance now, which is kind of a first.
My pleasure, Angela. And honestly, just doing that one thing, getting a personal loan quote before you walk into the dealership, that alone puts you ahead of most buyers. Good luck out there, everyone.
Quick side note, this guide connects with other cost saver blogs, especially how much emergency fund you actually need, financial goals planner, and council tax band right.
Exactly. And reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like UK Car Finance Engine, PCP versus HP versus personal loan right after this episode.
Primary sources used here include Money Saving Expert and Which Car Finance Explained, so you can verify the data yourself and stay evidence-led.
That wraps this cost saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try UK Car Finance Engine, PCP versus HP versus personal loan, then read how much emergency fund you actually need and use them together to take action today.